Well, it was a pretty crazy day where we saw a nice snapback rally today in most areas compared to where we had some sell-offs yesterday. And of course, the tone was set this morning as Walmart, the world's largest brick and mortar retailer, did come out with an excellent earnings announcement. That stock skyrocketed 10% here today. So that helped elevate a lot of those different indices out there like the Dow Jones and the S&P 500. So we'll take a look at what all that means for the various postures of the market. And we'll also take a look at a speculative trade within an oversold area of the market, more of a kind of counter trend trade that we're going to discuss in our trade application example for the day. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's August 16th, 2018. For those of you that are new, first of all, welcome aboard. We're grateful to have you in our audience here tonight. As a reminder, you can subscribe to our YouTube channel, and while you're over there, look in our description area. There's a link that can sign you up for the various emails we send out regarding these videos, and also alerts you to what stocks are giving you overbought and oversold cluster signals, and one of those we'll talk about here today in our trade application. In addition to that, we're also heavy users of Twitter. I mentioned Walmart earlier here in the presentation. Of course, Walmart was one of the stocks I discussed on Twitter this morning on my 9 at 9. So make sure you're checking that out at 9 a.m. Eastern time if you want to see the stocks that are going to move the market before they actually open up the stock market for the day. My handle is at Brandon Van Zee, all one word. Make sure you're following me, and if you get value out of these videos, make sure you click like and retweet as well. And then also, we're on Facebook. You can check out that web address in the logo in front of you. All right, with that, let's go ahead and take a look at the market analysis for the day. As you can see here, I've got chart 4B pulled up for those of you that are premium market scholars. Remember that this particular chart setup is going to look at the 4 different indices here in the United States, the 4 major ones. We've got the S&P 500 in the upper left, Dow Jones upper right, got the NASDAQ in the lower left, and the Russell 2000 in the lower right. And when you see the background color of the charts be green, that means that we have a bullish intermediate term posture using the market forecast indicator. If you see the background color being red, that means we have a bearish posture using that same indicator. Well, that's what made things today a little bit interesting. We've got a little bit of a variety. All of the indices were up today, so that's a good sign if you're bullish. But you'll notice here that we actually flipped from bullish to bearish posture on the S&P 500. So although we went up 0.79%, which is actually a pretty healthy day, it didn't stop that posture from kind of changing back to more of a bearish setting. So you just got to be a little bit more cautious about that. But as you guys have heard me discuss regularly in these videos, I don't look at that as a terrible thing as long as we're still above a rising moving average, and that is where we're at right now. Remember, this is a precarious position for that green line, that intermediate line on the market forecast, because it's basically just barely below that 80 line. Remember, it could easily flip back into the upper reversal zone tomorrow, and that would flip back to a bullish posture. So these are kind of those times where when you're in the transition, until you see a few days in a row of it, you're not quite sure if that's what if it should be bullish or bearish. So right now, that's kind of where I sit. Yes, indeed, it does show as a bearish posture, weak bearish posture, but with that nice bounce off of that rising moving average, I still am a little bit cautious about that sort of a posture. I think there's still some life to the bulls out there. You will see that because of the big impact that Walmart has on the Dow Jones. Remember, there's only 30 stocks there. So we had not only Walmart come out with excellent earnings, we also had Cisco, the technology giant, come out with excellent earnings. And then we had Boeing and some other big players within the Dow do really well today. So the Dow was actually our biggest winner of all the 4 indices today. It was up 1.58%. And you can see the size of that candle there just erupted higher off of that rising moving average right there. And you'll notice the background color now on the Dow is actually the opposite. It's green. So in the case of the S&P 500, it went from green to red. In the case of the Dow Jones, we actually went from red to green. And so we flipped back to a bullish posture here. And again, that makes sense. We're above a rising moving average. Price is still behaving itself. As you can see with some of these other postures down here, NASDAQ did flip to a bearish one, just like the S&P 500 did, as that green line fell below that upper reversal zone. And then we've had a bearish posture on the Russell 2000 for the last couple of days. But just like I've mentioned to you guys several times in the last couple of weeks, I don't view the Russell 2000 personally as really bearish. Yeah, the posture might be bearish, but the price action suggests sideways to neutral action, which is why we have that iron condor that continues to be on with that Russell 2000. So let's go ahead and take a look here at our next chart setup. And this one will be our chart 4C, and this is our 3 green arrows setup here. And so we kind of get a sense of whether we have 3 green arrows, 3 red arrows, or a mix of green and red arrows by looking at the background colors of the charts. In the case of the S&P 500, you'll notice it's a white background next to the candle up here. And so that tells us we have a green arrow on one of the metrics, the 30-day moving average, but we do have red arrows in the case of the MACD and the stochastics. However, these things are getting closer to reversing course there as well. In the case of the Dow Jones, we're also kind of mixed signals there. Yesterday we actually had 3 red arrows, but today's big move higher kind of offset those red arrows, and we got a green arrow back on the moving average as we close back above that moving average. We actually got a phantom green arrow down here on the stochastics, and we're on the verge of getting a green arrow back there on the MACD, so we'll have to keep our eyes on that. As we look at the other charts out there, it's a lot of the same, where we've got the mixed green arrows, red arrows action. So that's kind of giving you a sign that there's a possible transition that's taking place with the market right now. Let's go ahead and take a look at our next chart setup. This will be our longer term view. This is chart 4D. This is our long-term 1040 crossover method is what you'll hear us refer to this as. And what we're looking at here are exponential moving average. These are weekly candle charts. So it's a 10-week a week moving average versus a 40-week moving average using exponential moving averages. And as you can see here, the background colors of the charts will turn green whenever we have a bullish posture from this perspective, and they'll turn pink whenever we have a bearish posture. But it's been more than 2 years since we've had a bearish posture, because the markets have largely been bullish for 2 full years at this point. Markets have not been as strong in 2018 as they were in 2017, but we didn't expect that to happen, right? 2017 was an exceptional year. So the point is, despite having a really robust year of 2017, we have not fallen apart in 2018. We've held the line. And so that continues to be the path of least resistance, is for stock prices to go higher. Let's now do some 12 grid analysis, starting with chart 4E. And this is our intermarket analysis 12 grid here. As that pulls up, a reminder, when we look at the background colors of these charts, it tells us we have bullish postures using that intermediate term line on the market forecast. When we see the pink background colors, it means that we have bearish postures. So what I'm usually looking for here is just either continued trends or possible trend reversals. And one of the things that we've been keeping our eye on here recently is the US dollar. Notice that the US dollar did pull back today, not a whole lot, but at least it stopped going up at the same rate that we've been seeing in the last week or so. But strangely enough, the gold market did not react to that. Notice that gold is just kind of in a death spiral here. It cannot get out of its own way. We are now down 8.46% in just 3 months' time in gold futures contracts. And so where we stand right now is $1,180 an ounce, but that's a pain train right there. The thing is, you are getting some of those oversold cluster signals, but the problem is those oversold cluster signals really haven't been worth paying attention to in the past if you were expecting a reversion to the mean. Ag commodities and crude oil both did go up today. And so that is kind of the expectation. When the dollar's down like it was today, you would expect commodities to be positively benefited by that. Gold was not benefited, but at least ag commodities and crude oil were. And keep that in the back of your mind. Our trade application here in just a moment will come from the crude oil space, or the energy patch. Notice that REITs continue to do real well. I tweeted that out a couple of days ago on one of the REITs that we had focused on in my dividend growth investing class, Welltower, a couple of months ago. And that stock has been on a nice move, ticker symbol WELL, but they're not alone. A lot of REITs out there really starting to make a move, and we continue to be bouncing off of that rising moving average when it comes to REITs. Let's take a look here now at our next 12 grid. This will be our foreign stock markets 12 grid, chart 4F for those of you that are following along at home. And here it's a bit more of a mixed bag. Now the one that does stand out is down here, Israel, and that's one that we've talked about quite regularly in these presentations in the past. It's one that has kind of remained more resilient than most of the other world markets around us, and boy, oh boy, did Israel have a great day. It was up 1.87% for the whole country index, but take a look at that candle. That's a beautiful looking candle right there. In fact, that's a new 3-month closing high on Israel. It wasn't on an intraday basis. This candle was a little bit higher right there intraday, but on a closing basis, this is a new 3-month high for Israel. So that is one of the international markets where it's been worthwhile kind of hiding out. Otherwise, you see a lot of red on the boards. You know, today's markets were kind to the foreign stock markets, but it just hasn't changed the trends in many cases. Many of these trends remain very difficult. Some of them have gotten to a point where they've reached some oversold signals. So perhaps we'll see some snapback rallies in South Africa, which remember is somewhat more gold oriented. So keep your eye on gold if you're interested in South Africa. But United Kingdom also has some oversold cluster signals here, so who knows, maybe we get a little snapback there, and then Russia as well. So we're getting to a point where things have gotten pretty extreme. Doesn't mean that the trend will change from bearish to bullish, but it's possible that we'll get some snapback rallies at least in the next week or two. As we take a look at our next 12 grid, let's discuss the U.S. sectors now. This is chart 4G. And as you can see here, we do have more red or pink background colors than green. And so as a reminder, the ones that are more resilient right now are the more defensive ones, right? We look at healthcare here that retains its bullish posture. It's off to the races. New 3-month highs were up 9.5% in healthcare in 3 months. Notice that staples, actually after today's robust move out of the staples, take a look at that. Staples were up 1.4% today. That actually puts them in the lead horse race out of all of these different charts on a 3-month basis. They are now up 9.9% over the last 3 months. Remember, at the beginning of 2018, people were basically writing off the consumer staples. Well, they've come roaring back. They're now leading neck and neck with healthcare. And also in that conversation are utilities and real estate. Notice that real estate is up about 9.45%. Utilities are up about 9.84%. So we've got 4 sectors that are kind of neck and neck for buying for best 3-month performance right now. And what all 4 of those sectors have in common is that they are all defensive in nature. And that's one of the things that I've been pointing out in my top-down trend trading class here in recent weeks, just because that's what we've been seeing out of the sector selector tool as well. Now, the other one worth mentioning is that telecom, although it's not up as much over the last 3 months, it's only up 6.6%. It did have a nice clean breakout if you're using IYZ as your gauge within the telecom space, and that's the other one that kind of has that bullish posture. Otherwise, the more cyclical areas of the market right now are the ones that are struggling a bit more. You know, in the case of materials and energy, those two are very much associated with what's happening with commodities, which are, of course, thrown around depending upon what's happening with the US dollar. But as I mentioned a moment ago, US dollar was rolling over a little bit here today. We did see a pop higher in the crude oil markets, the futures markets, and that did help energy here as well be up 0.72% today. Now, one thing I wanted to point out about energy, since we're talking about it, is notice that energy, out of all of our different sectors here in the United States, it's the only one that as of right now has what's known as an oversold cluster signal. We're getting that kind of green dot showing up below the price. Remember, if you ever wanted to review that in a little bit greater detail, you can just right click on the chart and go to maximize sell, and you can kind of see that down below we have the green, the red, and the blue lines all in the lower reversal zone below 20 on the same day. This is actually the second straight day that we've had an oversold cluster signal. Now, that doesn't guarantee that it's going to reverse higher, but oftentimes we do find that that leads to some success where that pain to the downside is kind of reversed to a degree to the upside. Now, it doesn't mean that all of a sudden you're going to go into a huge uptrend, but you will see, as just one example here with the financials, notice that we had that green dot show up back here on the financials back at the end of June. That would have been an interesting time to take a reversion to the mean type of a trade, a counter trend trade, because remember, prices were falling significantly going into that oversold signal, and then they rallied strongly out of it. Now, again, that's not going to happen every single time, but that's where we stand right now with energy. Things have gotten pretty ugly in a hurry here with the energy complex. And so that will then lead to our trade application example for the day. So let me come on over here to chart 4A, and we're going to take a look at a company called EOG. Now, for those of you market historians, you'll know that this company calls itself EOG because they didn't really like the name Enron Oil and Gas, and that's where this company has its roots. But it did survive Enron back in the 2001-2002 time period, and has continued to be actually quite a successful oil and gas exploration company. Well, you'll notice that like a lot of oil and gas companies, this thing has just been crushed in the last couple of weeks and months. It topped out at about 131 and has gone all the way down here to 115, which is where we find ourselves right now. And of course, you can see down below that we now have what's known as an oversold cluster signal using this market forecast tool. Again, that happens when we have blue, red, and green all below 20 on the same day. Now, you got to be careful with this because not all securities will respect that particular trade setup. And so one of the things I like to do is kind of get a sense of how this particular security has handled that particular signal in the past. Well, you'll see here in the last 3 months, we have 0 signals when it comes to oversold signals. It just hasn't gotten as extreme as it is right now in the last 3 months. So let's go back a little bit further in time and just kind of see how this one does. I'm going to come over here to, let's go to the drop down where we can select a different time frame. I'm going to choose time frame over here. Let's go to 2 years and just leave it as a daily aggregation period and click OK. Now you'll notice as you're looking at this chart, there are more occurrences in history for EOG to have these oversold cluster signals. The most recent ones occurred right here, kind of where I'm circling my mouse, and this was a back-to-back days back here in, looks like it was March of 2018. Well, you'll notice that after selling off significantly, it got those oversold cluster signals and then it ripped higher. And the other times that we had it was back here, kind of circling it again with my mouse, and this time would have been in August of 2017. It had sold off significantly. This one didn't rip immediately higher. It kind of went up a little bit for a week, came down, reestablished its base, and then it ripped higher. So the point is, had you been doing bullish trades on it right here, you would have benefited a month or so later. And then this one did okay. This one didn't rip higher quite as much as the other ones, but you can see that if you would have bought this company over here on this oversold cluster signal in June of 2017 at around $87, you had much more bullish activity after that than bearish activity. So the point is, we look back a little bit further amount of time, this one strikes me as one that does a reasonably good job of indeed reverting back to the mean. Now, of course, it's a dangerous trade, you know, and that's what David and I stress here with these trades as well, is that oftentimes you want trend on your side. This is one of those rare circumstances where this is going to be a counter trend trade. I just want to be very clear about that because, you know, when you're making a decision on which trades to take and which ones you won't, if you don't feel comfortable with counter trend trades, you shouldn't be touching this one. On the other hand, if some of you are interested, maybe you position size a little bit smaller on a situation like this where the trend is clearly against you. It's just known as a little bit more dangerous here when you're kind of playing those games. But what I thought we would do is do what's known as a bull put spread. And by doing that, we can have kind of a defined risk trade. Now, actually, that reminds me, I had an excellent conversation here a little bit earlier today in my question and answer class. Here are some of the different questions and answers that we went through here today. For those of you that are Premium Market Scholars subscribers, you're welcome to go back and watch the recording. I do have that posted already. We talked about YouTube clarity and resolution. We talked about Whirlpool today. We talked about how can we find new dividend growth investing candidates. Talked about Synchrony Financial. We talked about Walmart, Hershey's, and Starbucks. We talked about Flowers Foods. talked about some spreadsheets to use, talked about blockchain technology of all things. We talked about Walmart again, our dividend stair steps. We talked about Cracker Barrel. We talked about looking at the fundamentals area of the Analyze tab. We talked about how to derive liquidity from various situations when we're dealing with vertical spreads. We talked about looking for value stocks and Apple and a few other things there. So anyway, good conversations that we had there today. But in particular, when we're looking at these counter trend trades, you have to ensure that that liquidity, and you want that defined risk. And so if you want that conversation a little bit more, it's 2 hours and 39 minutes in on the recording where Robert asked me the question about vertical spreads and liquidity. We talked about how the market makers can really blow out the spreads and different things like that to a point where if somebody has a really negative knee-jerk reaction, they can actually lose more than what the defined risk of the trade suggests that they should risk. So you just got to be careful with that term. We use it loosely. We're assuming you're going to act rationally when we use a term like defined risk. And if you're blowing yourself out at unfavorable prices, then then there may not be defined risk in that particular case. But for the most part, it is an appealing aspect of a trade like this, because we can kind of go into it saying, okay, well, we have a downtrending stock here, but clearly it's at a point where some folks might consider it overdone to the downside, and we might be due for a little bit of a bounce. Not only do we have that oversold cluster signal, but we're at this area that we bounced from on EOG back here in June as well. So this is a counter trend trade. If we come over here to the trade tab, you can see that I've got the September weekly contracts pulled up with 29 days until expiration. So these are the ones that expire a week before the monthlies in September. So this is September 14th week is what we're looking at. And what we're looking for here is usually starting with a delta of around 30. And so that's your 112 strike right here. So I'm going to right click on the 112 puts, and I'm going to go to sell, and this time I'm going to go to deep and wide, and I'm going to do 1 month 2 strike vertical, and that will load up our trade down below. Now by going to deep and wide, what I effectively did was I just instructed the computer to load up a $2 wide spread, because if you just use the normal default settings for selling verticals, it would load up a $1 wide. Well, in this case, we're going to do a $2 wide. Remember, that can help save commissions and different things like that as well. You don't always get the ability to do them at the return on risk that you want, but in this case here, you can see that we would receive 49 cents for selling this $2 wide vertical spread. Now, as a reminder, if you wanted to see what your return on risk is when you're doing any type of a spread, just click on confirm and send one time, like I've done right there, and then get your calculator out and take the max profit number, in this case 49 if we're just doing one contract, 49 bucks divided by max loss, 151. And you can see here that we had a 32.5% return on risk approximately. So it does get up and over our 30% hurdle rate that we generally are shooting for. And so, what you're looking at there for this type of a trade, for those of you that are newer to selling bull put spreads, is you're basically saying to yourself, I want this stock to stay above the strike price of which you sold. In this case, the sold strike price, so sell line here, buy line right here. So the sell line shows that you're selling the 112 put in this case. So in other words, you're making a bet that this stock will stay above 112 for the next 29 days. And if you're right with that bet, then you keep the 49 bucks that you're taking in when you start this trade. Where you get in trouble is if this stock does not stay above 112. And remember, that's entirely possible. This is a stock in a downtrend right now. It's entirely possible that it could continue to go lower if it does not revert to the mean. And that's where it's helpful to have the 110 bought put as part of this trade. Because if this stock were to just plunge between now and our expiration date, 29 days from now, if it goes all the way down to $100 per share, then by having a long put embedded in this trade, we are then kind of protected the further down it goes. Now, we'll still lose money. It's just that we won't lose incremental amounts of money because we've protected ourselves below 110. The worst case scenario for us, again, assuming you're not making some sort of crazy knee-jerk reaction at the wrong time, our worst case scenario, remember, is what we mentioned before. It's $151. So that's kind of nice there as well, because I mean, you could also theoretically sell just a naked put on this, but the problem is with a naked put, if that thing went down to 110 or 100 or 95 or 90, you're losing more and more money along the way. This caps the losses below 110. Okay, so that's kind of what you're hoping to accomplish here. You're mildly bullish on this. If it goes sideways and stays at 116, you're good to go. If it goes up and reverts to the mean, you're good to go. If it even goes down, but just doesn't go down by more than, let's call it $3 or $4, you could still end up making money on this trade. What you don't want is for this thing to continue plunging for the next 29 days. So I'm going to go ahead and place that trade, and we'll see how that does starting tomorrow. All right, well, I want to thank you for joining me here tonight. As a reminder, David will be with you tomorrow. I'll be doing my sector selector tool, so for those of you that are premium scholars, be on the lookout for an email from me on that as well. And then I'll be back in the saddle next week on Tuesday, but on Thursday I am taking the day off, so you'll get a little bit more of David than me next week. But wherever you're at, I want to wish you a great weekend. Best success with your trades and your investments. Goodbye for now.